In recent energy market developments, U.S. crude oil prices have shown a notable rebound, following an unexpected decrease in domestic stockpiles. According to the latest report from the Energy Information Administration, U.S. commercial crude inventories saw a significant drop of 1.4 million barrels in the first week of May. This decline was surprising, especially when juxtaposed against industry expectations, which had forecast a build of 509,000 barrels. The unexpected decrease provided a much-needed boost to oil prices, which had been under pressure due to a consistent increase in inventories noted at the end of April. The pricing dynamics observed were as follows. The June contract for West Texas Intermediate (WTI) crude rose by 34 cents, reaching $78.73 a barrel, which represents a 0.43% increase. Meanwhile, Brent crude for the July contract modestly increased by 21 cents to $83.37 a barrel, marking a 0.26% rise. Despite these increases, oil prices have seen a more than 7% decline from their April highs, which were largely driven by geopolitical fears, particularly concerns over potential conflict between Iran and Israel. These fears had previously instigated a speculative rise in oil prices, adding a war premium that has since dissipated as tensions eased and the perceived risk of conflict reduced. Morgan Stanley analysts have highlighted that although the oil market has softened recently, they anticipate a return to strength in the coming months, driven by seasonal demand. They also predict that OPEC Plus is likely to extend its production cuts until the end of the year, which could lead to a significant deficit of about 2 million barrels per day in the third quarter, potentially pushing Brent prices to around $90 during the summer period. The broader energy sector is witnessing various significant activities, including Microsoft's ambitious investment of more than $10 billion in renewable energy to power its data centers. This move underscores a growing trend among major corporations to invest heavily in sustainable energy solutions as part of their operational strategy and commitment to environmental stewardship. Additionally, ExxonMobil is actively developing technologies aimed at removing CO2 from the atmosphere, reflecting an increasing focus on climate change mitigation strategies within the oil industry. On another front, U.S. solar manufacturers have petitioned the government to impose tariffs on imports from 4 Southeast Asian nations, signaling ongoing tensions and challenges in the global trade of renewable energy resources. These developments highlight a dynamic and complex landscape in the energy markets, characterized by fluctuating oil prices, strategic shifts towards renewable energy, and ongoing adjustments to global geopolitical and trade-related pressures. Stakeholders across the spectrum, from investors and corporations to governments and environmental groups, are closely monitoring these trends to navigate the challenges and opportunities they present in the pursuit of both economic and environmental goals.